Hey guys, welcome back to the channel. I'm Luke, an ACA qualified accountant, and in today's video we're going to introduce the concept of provisions. We'll discuss what a provision is, how we record a provision within the financial statements, and also how we account for an under or over provision. So yeah, let's get started. Okay, so a provision is a type of liability which is recognised when a company has an obligation, but where they aren't certain as to how much it owes or when the payment to satisfy that obligation needs to be made. So in essence, provision represents money set aside by a company to cover a likely future cost, for example, a legal claim, a product warranty, or a restructuring cost, even though the full details of that future cost aren't yet known. So under IFRS, provisions are shown as liabilities on the statement of financial position, but they're reported separately from other liabilities because provisions aren't known amounts, they're estimates calculated based on an accountant's judgment, and therefore users need to be aware of this when interpreting a set of financial statements. It's also important to distinguish provisions from accruals. Accruals relate to future obligations where the amount owed is known, so things like unpaid wages, whereas provisions relate to obligations that exist but where the amount owed is very uncertain. So in short, provisions are important components of a balance sheet because they help ensure that businesses are reflecting future costs within their accounts, even when the amount that is owed and the timing of that payment aren't certain. So let's now look at three real-world situations where companies typically recognise provisions in their financial statements. These are cases where the business expects to face future costs, but where the amount or timing of those costs is uncertain. So first, we have legal claims. If a company is facing a lawsuit, for example, from an injured employee, and its legal advisors believe the company is likely to lose the case, then a provision should be recorded within the financial statements. Even if the final settlement amount is unknown, if the obligation is considered probable, then a provision ensures that a liability is accurately reflected within the accounts. Second, we have warranties. Many businesses offer warranties on the products that they sell to their customers, which means they'll likely face future repair or replacement costs for faulty items, which they can estimate and reflect in the financial statements using a provision. And third, we have restructuring. So if a company announces a formal restructuring, say they want to close a branch or make redundancies across their business, then any expected costs need to be recognised as a provision. So what sets these types of provisions apart from accruals and other liabilities we've seen so far is that they all involve uncertainty. So we don't know exactly how much the business is going to owe and when those payments will fall due, but what we do know is that an obligation does exist, so that has to be reflected somewhere in the liability section of the balance sheet. And we can do this and reflect this by recording a provision. So in this slide, we'll look briefly at what criteria needs to be met for a provision to be recognised under IAS 37. So IAS 37 ensures that companies only recognise provisions when there's a valid reason to do so, and that any amounts that are disclosed are based on sound and robust estimates and are supported by proper accounting judgment. So to recognise a provision, three criteria need to be met. First, the company must have a present obligation. Second, it must be probable that settling the obligation will lead to a cash outflow for the business. And by probable, we mean that there's more than a 50% chance of a cash payment being made. Third, the company must be able to reliably estimate the outflow amount. If all three of these criteria are satisfied, then a provision must be recorded within a company's financial statements. And for the sake of this exam, you'll only need to focus on provisions that are expected to be settled within the next 12 months, which are shown as current liabilities on the statement of financial position. You don't need to worry about provisions that are further out, longer than 12 months. So one key thing to understand about provisions is that they're not certain amounts, they're estimates. So accountants use their professional judgment to decide how much to set aside for provisions in the financial statements. And because of this subjectivity, provisions are reported separately from other liabilities on the statement of financial position. This separation will help users of the financial statements clearly identify what portion of a company's liabilities are based on estimates and which figures are more certain. So this separation increases transparency and highlights that provisions require a higher degree of professional judgment than typical trade payables or accruals balances. Additional information regarding the provision is included in the notes to the financial statements, which allows users to help understand the nature of the provision in greater depth, but also how the accountant arrived at that amount. Okay, so here's how we account for provisions within the financial statements using journal entries. And we do this by following two simple steps. Step one is to create the provision. So when a company expects to incur a future cost, we need to recognise an expense in the income statement, and we also need to recognise a matching provision on the balance sheet. So the journal entry to reflect this is debit expense, credit provision. Our second step is to settle the obligation. So when the business actually pays the amount owed to settle the obligation, the provision needs to be removed from the balance sheet. And also cash at bank needs to be reduced because a payment's been made. So the journal entry to reflect this second step is debit provision, credit cash. It's worth acknowledging that when recording a provision, an expense is only recorded when the provision is first created. It's not recorded when the cash payment is made. And that's it. That's the standard accounting treatment that we apply for provisions when the original estimate of the future obligation turns out to be accurate. But what if in step one, we over or underestimate the amount that's owed? Or in other words, what if we under or overstate the provision in the financial statements? Well, over the course of the next few slides, we'll look at how to account for over and under provisions. Let's first look at how we account for an under provision. This is a situation where the business initially underestimated how much it would need to pay, so the original provision that was recorded wasn't big enough. So when the actual cost arises in step two and we need to settle the liability, we need to do three things. One, we need to remove the original provision from the balance sheet. Two, we need to reduce the cash balance to reflect the amount that's been paid. And three, we need to recognise the extra additional cost as an additional expense in the income statement. So to reflect the under provision, the full journal entry becomes debit expense to record that additional expense amount that wasn't initially provided for. We debit provision to remove the provision that was recorded in step one, the initial provision amount, and we credit cash to reflect the cash that was paid out to settle the claim. So this adjustment ensures the total cost is fully recognised in the income statement, even if the original provision estimate fell slightly short of the mark. Now let's walk through how we account for an over provision. So this happens when the business initially overestimated the future obligation and recorded a provision that turned out to be too high. So in step two, when the actual cost is incurred, the amount paid is less than what we had previously set aside. So to adjust for this, we debit the provision to remove the full balance from the balance sheet. We credit cash to reflect the actual amount that's been paid by the business, and we credit expense for the difference. So we're reversing the part of the cost that was overestimated in the income statement in step one. So this adjustment ensures that the business is only recognising the amount it actually incurred in its income statement, and it's not accounting for the overstated estimate. Okay, in this example, an employee has injured their hand while using unsafe company machinery and is now suing the company for damages. So the legal claim amounts to £500,000, and we're told that it's likely to be settled within the next 12 months. The company's lawyers believe that there is a 70% chance that the employee is going to win the case, and if they do, the payout will be that £500,000. So our task is to determine how this should be accounted for in the financial statements. So because the probability of a cash outflow is greater than 50%, and because the company's lawyers have been able to reliably estimate the amount that would be owed, this situation meets the IAS 37 criteria we looked at earlier for recognising a provision. We therefore record a provision of £500,000 at the year end date of 31st of December 20x1. So the journal entry to record this provision, as at the end of 20x1, is debit expenses 500,000. This goes to the income statement as a charge for the year, and it reduces profit for the period. And we also need to credit provision by the same amount. This creates the liability on the balance sheet. The provision reflects the company's obligation and ensures that the expense is matched to the period in which the incident and legal obligation arose. Now, carrying on with the same example here, we're told that on February 20x2, that should say 2, the legal claim was settled and the company paid £400,000 worth of cash to the employee to settle the legal claim. But remember, the company originally recorded a provision in their current liability section of £500,000. That means the business overestimated the provision by 500,000 minus 400,000, which equals £100,000. So how do we account for this over provision within the financial statements? Well, we first need to remove the entire £500,000 provision from the balance sheet by debiting the provision account. We credit the cash account by £400,000 to reflect the actual payout that the company's made to the employee during the year ended 20x2. And finally, we need to credit expenses by £100,000, because this reverses the part of the provision that turned out to be too high. We overstated expenses in the previous period in 20x1 by £100,000, so it's only right that we reduce expenses by £100,000 in the year ended December 20x2, reflecting the fact that we understated the company's profit in the previous year. So this is a good example of why provisions are so subjective. Even when we try to estimate them carefully, the final amount owed can actually be very different from what we expect. And when it does differ, the accountants will need to make sure the financial statements are accurately updated to reflect that difference. Okay, so that's provisions in a nutshell. If you've got any questions regarding provisions, how you record and reflect and adjust under and over provisions, please feel free to fire any questions off in the comments. If you like the video, please smash the like button and consider subscribing. I'm making tons of videos about the Accounting Fundamentals exam. So I'll see you in the next one.